Welcome back to the channel. Today we're chatting about how the federal budget has changed our investing strategy. Now let's jump into it with my disclaimer, of course. This is for educational purposes. I'm a teacher. I like to chat about finance, so I combine those two things into educational content. Now, I also want to sometimes add our own story to those numbers to help explain it even better. So none of that is financial advice. So let's keep that in mind as we move through the video. So let's chat investment property first, because we bought an investment property 2 years ago. So we haven't had it for that long. So the capital growth hasn't been huge, but there has been some. So we purchased the property in 2024 for $905,000. And it's currently valued at $1.12 million. So on paper, that's roughly a capital gain of $215,000. Right now, it doesn't make sense for us to sell that property because the capital gain just doesn't seem to be worth it at this point in time. Plus, we'd still get those capital gains that we have made and that we continue to make, well, hopefully continue to make until the 1st of July 2027. So yes, those capital gains are there, but they get to have that discount. It's all the gains from the 1st of July 2027 onwards. So at this point in time, we're holding the investment property. It also doesn't make sense for us to sell that property because it is negatively geared, and we do want to have an investment property anyway. So we sold that property to make use of the CGT discount. We would eventually be wanting or looking to buy an investment property anyway, and then we'd be buying one that potentially isn't negatively geared. So to us, it makes sense to hold that property at this point in time. Something I did consider though was switching the loan to investment only, because I thought if this loan is negatively geared and we can't get another negatively geared loan for a property, why are we paying down the loan? But then I thought about it a little bit further. I really didn't want to pay the extra interest rate that comes with interest only. Plus, we've paid down all our non-deductible debt. So paying a little bit off the principal of the investment property makes sense for us right now. But it is something that I did consider. And as we're getting closer to retirement and hopefully early retirement, it does make sense for us to be slightly lowering our debts and maybe even lowering them some more as the time gets closer. But at the moment, we're still in the stage of wanting to increase our assets. Although there is one option that I think could really work in our favor, our current home. It's currently paid off. It's currently valued around $1.4 million. It's a big house. The investment property is a 3-bedroom, 2-bathroom. So eventually, if we ever wanted to downsize, we could potentially sell our primary place of residence without the CGT, hopefully, if things don't change again, and then take all of that money tax-free, pay it off the investment property and live happily ever after. Although I'm not sure I want to live in the investment property, but that's another story anyway. Now let's talk about our shares, because our shares are there to help with our early retirement, hopefully. The plan was to live off some of the dividend income, and then obviously that wouldn't be enough to live off, so then we'd need to be drawing down the capital. And now the changes to the CGT rules have really put a spanner in that plan for us. So we have changed our thinking around our shares and our investments a little bit, because the plan was to sell down some shares each year while we weren't working and make use of those lower tax brackets. And now that's not a thing. And we don't know if things are going to change again. But at this point in time, that's not a thing, because there's a minimum 30% CGT to pay, which kind of stings a little bit. And that's the part of the budget changes, well, there's a few, that doesn't make sense to me, because it just feels unfair for lower income earners. We're not rich and famous. We're not earning millions. We are middle-class citizens, really, a teacher and electrician. So yeah, that's the part that really doesn't make sense to me. So in our investment portfolio, we've always invested for growth and dividends, and definitely we're leaning towards growth as well. But now the budget changes have really changed our thinking around that. It's now made dividend investing just a little bit more appealing, and I really like dividends because I just love the psychological feeling of getting that money in the bank each month. Nothing better. So in our investments outside of superannuation, in our stock market portfolio, we are still looking at some growth. Obviously, we're not just chasing dividend yield, but dividends are now looking more appealing to us. Our current portfolio actually has a capital gain of just over 100K at the moment, and obviously that will apply to the old rules of CGT. But just thinking about having a capital gain of that much and having the new rules applied to that CGT really, really hurts. But anyway, making money, paying tax could be worse things in the world, obviously. So we currently have $540,000 invested in the stock market, but we also have a loan of $305,000 attached to that loan. So there does need to come a point of whether or not we do consider if we want to sell down some of those shares to pay off the loan, although I lean towards more just putting our extra cash into the loan so that we don't have to sell down any shares. The only thing that I am thinking about selling is one of our ETFs that I no longer want to hold. So it kind of makes sense to sell it before 1st July 2027, just so it's not as messy. And we do get that 50% capital gains discount. Now let's chat about superannuation, because we have investments outside of superannuation and investments inside superannuation. Since we're leaning towards dividend shares in our investments outside of superannuation, which are mostly Australian based for the franking credits and the dividends, we are leaning towards having most of our superannuation in a high growth international fund or investments. And then that means that the taxes work a little bit better for us with that approach inside superannuation and the dividend focus outside of superannuation. Now, before the budget, we were adding extra to our superannuation, so that really hasn't changed. But now I'm 41, so I'm kind of at that tipping point where prior to that, superannuation wasn't appealing, but now I'm seeing the benefits, and it's a little bit scary because seeing the light at the end of the tunnel, I don't know if it's a light or what you want to call it, because we're aging and we're going to get to 60 before we know it, and that's really, really, really scary. Our strategy with our superannuation at the moment is to make use of the carry forward contributions before they run out, which is when our portfolios reach $500,000, which is nearing closer and closer. So we are trying to put a fair bit into superannuation, and that's going to help with our retirement and even our early retirement, which we'll chat about, because the budget hasn't changed our long-term approach, and it hasn't changed the way or the will that we have to work towards financial independence. We've already reached coast fire if we include our investments inside superannuation and outside superannuation. So coast fire is having enough invested that you can stop your investing, and compound interest will do its thing to hopefully do its thing and continue to compound so you have enough in retirement. So our goal at the moment, we've reached coast fire that way. I really want to reach coast fire with our investments just inside superannuation. Once we hit that number, I feel like we can ease off the pedal a little bit. We can start to design our life around a little bit more flexibility. We will have everything that we need inside superannuation covered. And then outside of superannuation, we can even start to use that money now if we wanted to add a little bit more flexibility to our lives, or we can just ease back on the investing. So that is starting to look very appealing. Now, I know some people are either love superannuation or hate it, and I feel like it doesn't need to be one or the other. And I know I'm going to get comments about superannuation because people have very, very strong feelings about it. For us, it's making sense. We want to use those tax advantages inside superannuation. I feel most people are worried about whether or not the government can change the rules around superannuation, but what we've currently seen at the moment is that they can change the rules on other things and not just superannuation, because they've just changed the rules on things outside of superannuation. So yes, it can happen, and it's happened with investments outside of superannuation. So we're just going with what we've always done. We are earning what we can, spending less than we earn, and investing the difference. And I know that's going to have a benefit for us in the future. And hey, tax laws change and things change, and we don't even know when we reach financial independence, hopefully in 10 years' time, that these rules are going to be the same rules that apply when we reach financial independence and we're paying down our portfolio. Anyway, that's it for the video. I'd love to keep the discussion going in the comments in a positive, constructive way, because sometimes people can get very, very, very passionate about politics, I have learned. But anyway, I will see you in the next video.